for by the people. And I think that you, as a candidate, would fit you would fit the founders' idea as a candidate just so well in so many ways that I just think you should consider that when
certainly. I don't like
decisions.
career politicians. I don't think people should make a career out of politics. I think people should go to government to serve, kind of like you go to the military. You serve, you do a term or two, you do something good for your country, and then you leave. Most of our politicians who have been elected to office, they're not there to do anything good for their country. They're there because that's their career choice. They think that being in government is the way they can make the most money, whether it's directly through the salaries or through all the perks that they get, the ability to fly on private jets, to be wined and dined, to get power. And then, of course, some of the politicians who aren't there forever, they're only there as a means to an end because they think that they can get a lot of influence by getting friends in Washington, and then once they leave Washington, they peddle that interest to a lot of the special interests who are lobbying them. So it's a real dirty business, and it's as of yet it's not something that I'm intending to do. In fact, there's a chance I might not even be eligible because I might move out of the state of Connecticut. I just found out that Connecticut is that they want to raise the income tax in Connecticut from 5% to 8%. That's a 60% increase in the state income tax. And I would feel like a schmuck to just sit here and let them take all that money from me. I mean, it was back in the early 1990s. Connecticut didn't even have a state income tax. And then they put it in, and now the deficit is so huge, even with a state income tax, that they want to raise it. And the initial concept, Connecticut has a flat tax. Everybody pays the same 5%. If they pass this and they start the brackets and they stick an 8% bracket, you know what? It's not going to stay 8%. It's going to go 9%. It's going to go 10%, because this is not going to solve the problem. This is going to make it worse to increase taxes on the people that create the jobs and provide the employment. In fact, when I first moved to the state of Connecticut, when I moved here from California, the only reason I lived in Connecticut and not New York and not New Jersey was because Connecticut had a much lower rate of state income tax. But if they jack it up to 8%, yeah, it'll still be a little bit lower than New York and New Jersey, but you know what? Not much lower. And now that they've got the graduated tax, the progressive tax, it's very scary. It might go a lot higher. So I might have to move down to Florida. I got an office down in Palm Beach. My mother lives down there. It's nice warm weather. 8% state income tax in Connecticut, no state income tax in Florida. Seems like a pretty easy decision. So we'll see. But anyway, thanks for the call.
Yeah, no problem.
All right, I love it to see some of the young people obviously listening to it. I think it's good that college students, high school students are reading my stuff and listening to my stuff. Anyway, next up is Scott in New York. Go ahead, Scott.
Hey, Pete. Okay,
hey, Scott.
When the stock market goes up, people are buying things, and so there's less need for money, and the value of money goes down against foreign currencies. And
well, foreign currency.
Yeah.
Well,
how else can you measure the value of money going up or down if not by?
So when you're saying money, you're talking about the dollar. You're not talking about all the money. But
sorry,
yeah,
yes, I mean the U.S. dollar.
Yeah, you can measure the dollar's value in terms of other currencies, which is its exchange rate. You can also measure it in terms of the goods and services that it will buy. I like to measure the dollar's value in terms of gold. I think that's probably the best way to look at it. And, you can obviously see that over the last 9 years, the dollar has lost a lot of value. Gold was under $300 an ounce in 2000, and now it's approximately $900 an ounce. So the dollar has lost two-thirds of its value over the last 9 years. That's going to get a lot worse.
That's actually where my question is going. So, all right, so now we look at the converse. The stock market is going down. People are getting out of things, and so the value of the U.S. dollar, there's more of a need for the U.S. dollar, so its value goes up.
Well, that's what already happened. What happened, and I've talked about this before, as the crisis first began to unfold and people first started to see what was going on, they got scared, and so people were fleeing assets like stocks, like commodities, and they went to cash. They went to what was perceived to be safe. But
right.
That was the wrong thing to do. They did it, but what's going to happen is everybody who's been piling into cash is going to start to realize that there's no safety in that cash, that it's currency, that's in trouble. That the real risk is not assets losing value, but paper money losing value. And as people make that, connect those dots, it's going to go the other way. And so what's going to happen is everybody's going to want to get rid of their cash before it loses more value and buy more stuff, whether that stuff is commodities, whether it's stock in corporations, anything but the cash that the government is printing and debasing. And when that happens, it's going to be a rush to get out of cash, and prices are just going to skyrocket. I think stock prices ultimately are going to crash up a lot faster than they crash down, because no one's going to want to sell, everyone's going to want to buy, and as the velocity of money really starts to pick up, the cat's out of the bag. No one's going to want to be caught with it.
Right. So here's what I can't figure out: when the stock market goes down and people sit on the sidelines, there's more of a need for the dollar, and the dollar's value goes up. Yet simultaneously, when the stock market goes down, people flee to gold, and the price of gold goes up. Therefore, the value of the dollar goes down.
Well, what you're looking at right now is short-term, correlations in the market right now, where generally stocks go down, gold goes up. Stocks go up, gold goes down. Stocks go up, the dollar goes down. Stocks go down, the dollar goes up. There are certain short-term correlations that I think have more to do with just traders and what's happening as short-term money is moving around. It's almost like you think about people in a casino, and they're not really sure where to bet. They're very fickle. And all of a sudden they think, I think I'm going to go red 26 and stick the ships over there. Then they get a feeling, no, I want black 9. Or, no, you know what, I don't even want to play roulette anymore. I'm going to walk over here to the craps table. So people are constantly rearranging their bets and changing what they want to do from day to day. They hear one piece of economic news, it's deflation. They hear another one, it's inflation. This, that. It's all noise. What we need to do as investors is tune all that nonsense out and understand the big picture, understand where everything is going to be at the end, where all the chips are going to end up, and be there.
Yeah, because I'm just trying to rectify the apparent conflict of stocks go down, and so the dollar goes up. Stocks go down, and then gold, and therefore gold goes up, and therefore the dollar.
Look, there's nothing to rectify. It's not necessarily a conflict. Right now, it's basically what it looks like is people want more risk or less risk. When they're willing to take risk, right, they're willing to buy stocks, they're willing to buy the Australian dollar, they're doing things that are perceived to be risky. When they don't want risk, they want to buy dollars and they want treasuries. And so all those other things that are perceived to be risky go down. So that's what's going on. It's a seesaw. But it's all wrong. Because if people really don't want risk, then they don't want dollars. They just haven't figured that out yet. But pretty soon they will. And when the dollar is seen as the risky asset, when people who don't want risk also don't want dollars, that's when this crisis is really going to start to unfold and kick into a whole new gear. Anyway, thanks for the call.
Thank you.
Next up is Rick in California. Go ahead, Rick.
How you doing, Peter Schiff? I just bought your book, Crash Proof, online. And I had a quick history question. From 1981 to 2000, the inflation rate went more than 30%. We had a ballooning national debt, large trade deficit, just multiplying. Countries were just, printing all this, fiat currency from 1981 to 2000. My question is, why was gold in a bear market? Why did the price of gold not increase from 1980 to 2000? I know fundamental investors are supposed to be patient, but for 20 years, the price of gold didn't go up.
Remember what happened. Gold had its bull market from 1969, 70 to 1980. Gold went from $35 an ounce to $850 an ounce in one decade.
Yep.
And then it had a near 20-year bear market, and stocks had a near 20-year bull market. That cycle is over. Gold has now been in a bull market for the last 9 years. Stocks have been in a bear market for the last 9 years. I think we got at least another 9 to go, maybe more. So markets are moving in cycles, and now we're in a new cycle. But for a while, gold was in a bear market because nobody wanted gold. You can make more money in bonds. You can make more money in stocks. That's not the case today. You're going to lose a lot of money in stocks and bonds, relative to gold.
Yeah,
but a lot of people think,
My question is, even during those 20 years, the inflation, the trade deficit, they all ballooned, but everything was